Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about stock concentration and the Magnificent Seven. And what that means specifically is that last year, there was a group of 7 companies that produced a huge portion of the S&P 500's approximately 20% annual return. 500 companies in the index, 7 of them produced the vast majority of the return. So we dive into this today. We talk about the arguments for those 7 companies to continue outperforming, or any 7 companies to continue outperforming versus the rest of the field catching up. We talk about why these 7 companies might have been the ones to outperform, or really why they were the ones to outperform. And we compare this type of stock concentration to other periods historically, like the dot-com bubble, like the Nifty 50 group of companies back in the 60s and 70s. There's a lot of historical precedent for what happens over the next 10, 15 years or so, based on valuation, based on fundamentals and other measures. And we go through it in today's episode. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. So today on the show, we're going to talk about stock concentration, particularly with the Magnificent Seven, which I'll explain in a minute, what was just a massive driver of market returns from 2023. And this phenomenon of having a small number of companies deliver the vast majority of returns in the market has happened throughout history. And I have comments and an opinion on this because we're at a really interesting time in the investment markets, where a few short years ago, a lot of stock market performance was driven by the FANG stocks. So think back to Facebook, Amazon, Netflix, and Google. Now we're talking 3, 4, 5 years ago. And the market's had a couple of really good years. A lot of those returns were because those 4 companies had phenomenal years. And then right after that, Apple was added to the mix, and it became the FANG stocks, but 5 companies: Facebook, Amazon, Apple, Netflix, and Google. And those 5 companies out of all the let's call it 500 in the S&P 500, just looking at large companies here in the US, those 5 companies delivered a huge portion of the market's return. And then this last year, there were the Magnificent Seven. And I did prepare for today. Thank you very much. I don't always do that. But today I do have some stats and notes here alongside me. And last year, 7 companies that we're now calling the Magnificent Seven were responsible for a huge portion of last year's positive returns. The 7 companies are some of the same actors: Microsoft, Amazon, Facebook or Meta, Apple, Google, Tesla, and NVIDIA. With NVIDIA just really going, to the moon, as the kids say these days, with all the AI stuff going on. And so last year, the S&P was up as a whole about 20%, maybe a little bit more than 20%, on a cap-weighted basis. So the S&P 500 is cap-weighted. It's a cap-weighted index. We talked about that a lot on the show. If we take these 7 companies only on a cap-weighted basis, that group of 7 returned more than 100% on the year. Okay, so if you're listening to me say this and you're saying, well, holy smokes, I didn't double my money last year. We should be doing this, right? In order to actually get that 100% return, you had to identify this at the beginning of last year. And you had to put all your money into 7 companies only and guess right that those 7 were going to be the ones doing the best. And then you would have enjoyed all those great returns. So Of the 500, we have 7 companies that did better than 100% returns to shareholders I don't think any of these companies Microsoft pays a dividend, I think, and Meta might pay a dividend too. But the vast majority of the returns are from appreciation in price. They have revenues and expenses and business activities throughout the year. They're all AI adjacent, I would say. They're doing things that are kind of on the frontier of technology and innovation. They had good earnings, but the market thought that the future outlook for each of these 7 companies was so strong because of where we're at in the early stages of this AI revolution, if you want to call it that. Because, but investors in general thought that their outlook was going to be so good, that their revenues and profits were going to be so good in the future, that they bid up the prices of the stocks and they returned over 100%. So many more people were trying to buy the shares than sell them, that the market price went up. You know that whole song and dance. Now, of the 500 companies in the S&P, last year, 135 of them did better than the cap-weighted average. So that group, on a cap-weighted basis, returned a little bit more than 20% last year, right? Very close to 20%. 135 of the 500 did better than that 20%. The rest did worse. And in fact, of the S&P 500, there were 190 companies that actually had negative returns. That's 40% of the index had returns less than zero. Yet the index itself returned about 20% thanks to these 7 companies. This is an interesting thing that we haven't talked about a whole lot on the show. And what I wanted to cover today is historical precedent, supply and demand and valuation dynamics, and what the arguments for stock concentration leading to good returns versus leading to not so good returns is, because it informs how we should all be investing. And so working backwards, last year we had the Magnificent Seven. 7 companies out of the S&P 500 really drove market returns. Then we had the 5 FANG stocks. Then before that we had the 4 FANG stocks. Generally, what happens is anytime a company or a group of companies has a PE ratio above about 30, the next 10 years do not look so good. Okay? PE ratio, you take the price at which a company trades, the share value in the market, divided by the earnings that share is entitled to, earnings per share, that gives you the PE ratio. And it's a pretty basic metric to look at. It's not the only thing that we should be focused on. What PE ratio will not tell you is whether NVIDIA has some corner on innovative, has huge market share on some chipset that is going to be especially useful for AI companies over the next 5 years, right? That's a story and market position that PE ratio doesn't really well, I guess it could reflect. The market would appreciate that and value NVIDIA at a higher multiple, and therefore it could be reflected in the PE ratio. My point is that PE ratio in general is a valuation metric, and it doesn't tell us the whole story. So we as investors are always making decisions about how much of our portfolio to be putting into stocks and bonds and cash and real estate and alternative investments and so forth, crypto and everything. And of the portion of our portfolio we want to put in stocks, inevitably the question is, well, what stocks do we buy? Do we want some here in the US? Do we want some in other countries? Of the US companies, what do we buy there? And so buying the S&P 500 through an index fund is such a great way to get started, because you're just buying everything on a cap-weighted basis. But you're naturally going to skew toward these very highly appreciated, expensive companies when you measure them by PE ratio. Because the more expensive they are, the more inflated they are, the more frothy they are, the larger the portion of the S&P 500 that they will comprise, right? And right now, these 7 companies, because of how they did last year, are filling up a much larger portion of the S&P 500 index than a more level playing field. And so if you're somebody out there that owns a lot of the S&P 500 through an index fund or some other instrument, or maybe you're out there buying all 500 companies on your own, that's cool too if you don't mind the legwork. You have a very concentrated portfolio in that sector of the world. And this isn't the first time in history that this has happened. It was like this during the tech bubble in the early 2000s when internet stocks or internet companies, I should say, would go public without any earnings. But the story was the internet is going to be so powerful and so life-changing and so world-changing that the companies that are based on the internet are going to just have astronomical earnings and profitability and returns in the future. And therefore, we don't care. We're just buying everything that has to do with the internet that we possibly can. So companies went public. They took in a whole bunch of money. Not all of them were profitable, as we know. Some of them went bankrupt thereafter, and the bubble collapsed. Okay? Think back earlier than that. Back in the 60s and 70s, there were a group of stocks out of the S&P 500 called the Nifty 50. And this is something we've not talked about on the podcast in the past. So the Nifty 50, and the old Wall Street saying back in the day was, you just sell the blue chips and you get rich. And what that means is the way the financial markets were built and set up at that time, you could only buy stocks through a broker. You had to make phone calls to actually execute the trade. There were no phones, there were no computers yet. And the commissions that brokerage firms and brokers taking orders and managing client portfolios and so forth, the commissions that they received on these transactions were regulated and set by the SEC. And so stockbrokers at that time, the saying was that you're going to have a great career, you're going to make all this money. All you have to do is sell the blue chips. And the blue chips were the companies that were doing especially well at that time. And the group of them they used to call the Nifty 50. So back in the 60s and 70s, you didn't have to be doing anything fancy on Wall Street to do well. You just had to make relationships with people and get them to execute their orders through you by calling you up and saying, hey, I want to buy IBM, I want to buy GE. Those were 2. I'm pretty sure they were all in the index. I don't know if Pfizer was public by then. But these big blue chip companies were what comprised the Nifty 50, and they did great for a period of time in the mid-60s to the mid-70s. And then what happened in the mid-70s? We left the gold standard. We had oil embargo trade issues with the Middle East. Oil prices were crazy. We had shortages here in the U.S. Inflation was out of control after we left the gold standard. We had all sorts of problems. And that group of stocks lost 20% in 2 consecutive years. So they lost 40%. The math on that is not quite right. They lost 40% over a 2-year period, I should say. And if you do that geometrically with the math, it's not quite 20% a year. But over 1970, I think it was 1974 and 1975, that group of 50 companies, after doing phenomenally well, gave back a whole lot of those outside returns. And then in the 80s, some of them recovered, some of them did okay, but by and large, the group far underperformed the rest of the market because they were so expensive and so highly priced, and things just kind of normalized and came back to earth. And then now let's work forward again. Then we had the mid and late 90s, the internet's coming alive, internet companies are doing great. People are buying up anything that they can possibly get their hands on related to the internet. Internet businesses are going public without any, reasonable business models before they even have earnings. A lot of them went bankrupt. A lot of investors lost a whole lot of money in that. And then we have the mortgage crisis, which is it's a different animal there. That was a bubble, but it was in mortgages and the way that that the housing industry was really set up drove everything else down. And I guess you could argue that all of it was in a bubble at that time. But now you fast forward again, and we have a huge portion of the market's returns coming from a select few companies. So there are a couple arguments for this same small group of companies, and I'm thinking like Google, Amazon, Apple, Facebook, really those four, because they've been all four of those were part of both the FANG stocks here a few years ago. So they've been in this elite group producing returns for at least a few years now. And one of the arguments for someone who would say that they're going to continue doing really, really well, and therefore we want to, have a cap-weighted index that we're investing in, or maybe we want to even put more of our portfolio in those 7 companies. The argument for that is that they have intellectual property over technology that other people cannot regulate, or they are managed better than other companies. They have good governance, they have great managers, and whatever they're doing just continues to churn out great profits and earnings for investors. And that's really about it. Because the argument for AI in general goes far beyond these 7 companies. And so I'm saying these because these 7 companies right now are very expensive. Let me refer to my notes here. Microsoft is trading, and I'm looking at PE ratio. So remember that PE ratio, anything above 30 over the next 10 years. So if you have a PE ratio of 30 on day one, the returns over the next 10 years, 10, 15 years really don't look so good. And oftentimes there are, maybe they'll continue going up for the next couple of years, but there is just a large amount of mean reversion, is what the statistical term is. In other words, they kind of come back down to earth because there's always competition in our US and the global marketplace. So right now, Microsoft is trading at a 34.2 PE. Amazon is at 57.97. Meta, 31.94. I'm going to round this off to make it easier. Microsoft's at 34. Amazon's at 58. Meta's at 32. Apple's at 30. Google is at 27. They're the only one below 30. NVIDIA is at 72. Tesla is at 75. There's a lot of historical precedent. If you take 100 companies that are trading above a PE of 30, the vast majority of those 100 are going to have poor performance over the next 10, 15 years. And that's been true through every technological revolution that we've had since our capital markets really were formed back in, for the most part, back in the mid-late 20s and early 30s when the Fed and the SEC were created. We had it in the 70s. We had it in the tech bubble. We had it again during the mortgage crisis, and I can't articulate which group of companies was doing better at that point, but it's happened over and over and over again. So if we're investing now and trying to make decisions over how to allocate our portfolios, what stocks do we buy once we realize that we need something in or want to invest a portion of our money in U.S. equities, well, the evidence is just too strong to support concentrating on all the stocks that doubled last year. Are they likely to double again? I don't know. Anything can happen. It's possible, but I think it's highly unlikely. So that's just a little bit of background. Now, I saw a LinkedIn post by Josh Brown, who I think really highly of. I've met the guy a couple times at industry conferences. He's on TV all the time, but he has a very large investment firm that he's built up over the last decade or so. And he had a really good post, and it was basically he was linking to a blog post that he wrote, which I'll link to in the show notes because everybody should go read it. But it goes something like this. He said Netflix way back in 2009 was trading at 175 times earnings. Okay, so let's put this in place. The 7 companies I just rattled off, Magnificent 7 from last year, The highest PE ratio among all of them is Tesla at 75. Okay? Back in 2009, and we're saying that anything above 30 tends not to do so well. Netflix back in 2009 was trading at 175 times earnings. And between 2009 and through 2020, which is a period of 11 years, it returned 6,500%. So that's if you put $1,000 into Netflix in 2009 and you leave it in there over the next 11 years, it returns 6,500%, turns your $1,000 into $66,000 by the time you're done. That's it. That flies in the face of this. And so Josh's post was great. I thought it basically says Netflix was trading at 175 times earnings in 2009. Over the next 11 years, it returns 6,500% to brings $1,000 to 66,000. Yet here you are, concerned. We're at the beginning of the AI revolution, and everybody's concerned about PE ratios. And I thought that was a really good counterpoint to this whole argument of the fact that the same small group of companies, is not going to continue outperforming forever. And you are far more likely to realize a better investment outcome by just buying everything and level the playing field. There are always going to be exceptions to the general trend and the general rule, and Netflix is a great example of that. But through and through, every potentially world-changing technology that we've gone through has had this exact same experience. We don't have capital market history and data that's really comparable to the environment or the capital markets today to really explore what happened when the telephone was invented, but that was a big one. We do have information when computers came on the scene and began to be widely used in industry, the internet. Now we have AI. So if you're someone who thinks that AI is truly the thing and is going to be big or bigger than the internet was, then you should probably continue investing in a cap-weighted like index that focuses on technology and highly valued companies with a foothold in AI. I just can't see Google and NVIDIA and Microsoft continue to double this year like they did last year. I don't know everything about AI, and perhaps I'm going to be wrong, but it is just so exceptionally unlikely. Now, the other reason that I say that is recently we had a conversation on the show with Scott Christensen, who's a professor at University of Missouri. He does business and entrepreneurship courses. He's a self-described technologist. And he says, yeah, AI is great. It's cool, but it is overhyped. And while these language models that we are using and will continue to grow and adapt are going to be able to do some incredible and cool things, the environment we're in now is starting to look a little bit more like the Nifty 50 and the tech bubble. Those are not Scott's words, to be totally clear. I'm making the comparison. He's the one saying that AI in general is a little bit overhyped because it's just scraping a data set that we give it, be it the internet or some other data set, and then kind of predicting what word comes next for our use and our benefit. It's not going to be able to, take over a large number of jobs in the economy. It's not going to change the world as drastically, as suddenly as a lot of people are expecting. And for that reason, I'm more on the side of let's not get out over our skis. This is a potentially very cool thing, but at best, or I should say at worst, I would not want to skew my portfolio to be heavier in technology than what the S&P 500 cap-weighted index is already doing, because it's already pretty skewed in that direction. And time after time after time, the technology that everybody is hyping up and flocking toward and bidding up stock prices of, like the internet stocks in the early 2000s, while true that it is a world-changing technology, the story that the companies you're investing in are just going to go to the moon and give you, a 5,000% return is it just doesn't end up happening. Netflix is the aberration. There are stories from the early 2000s of companies that survived the tech bubble and did turn out, and I can't name exactly what they are, but they're out there. It's just exceptionally rare. And you're just better off over and over and over again throughout history, throughout any investing environment. You're better off just buying everything and weighting your portfolio toward factors that make sense to you. And if it's market cap, that's great. If it's other factors, that's better. Quality is a factor that's done really well recently. That's what Jeremy Grantham at his shop is a proponent of, and that's very similar to value investing, a little bit different. It's investing in good quality companies with a little momentum behind them. It is, I believe, the crux of that one. We're fans of the 3-factor model, which is value, size, and profitability. That's continued to do very well over a long period of time. But we're just in an environment to where the AI is very, very hyped and priced into the market in general. There's a general consensus that these AI adjacent companies are going to take over the world and continue to grow at astronomical rates. And I just don't see it myself. I think that AI is going to change the economy and change the world, but I don't think that it's out to get humankind in the next 5 years anytime soon. And I also don't think that competition is not going to catch up. There are going to be a lot of other companies that are not in the S&P 500 right now that are going to have great returns that will be added to the S&P and beat the Magnificent Seven from last year. There are other companies that did not do so well last year that are going to do great this year. We truly don't know what's going to happen, and that's too good of an argument for just invest in all of it. You're going to catch the winners, you're going to catch the losers, but you're diversified and over the long term will realize a better investment outcome. So that's it for today. I hope none of this was redundant. We hadn't touched on the Magnificent Seven in specifics yet, though, and so I thought it would be a good topic of discussion for today. We hadn't talked about the Nifty 50 either, and so it is an interesting phenomenon where a small subset, a small group of the market is the driver of returns, and oftentimes that's because of some new potential technology that's coming out. That's not always the case. The Nifty 50, that wasn't really the case. But that subset of groups that delivers great returns and gets bid up to very high PE ratios just doesn't tend to do as well as the market over the subsequent 10 or 15 years. So that's it for today. Thanks for listening, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.